Hi, everybody. Welcome to our first meeting of American Union Economics. We're all here because we're supporters of the American Union and the blueprint for a better America. So in the blueprint, it says welfare has a specific definition: the state of being or doing well, condition of health, happiness, and comfort, well-being, prosperity. The constitutional duty to promote this can be best met with universal basic income. Under this legislation, approximately 300 million citizens would get an unconditional American Union job, a no strings attached reminder of our constitutional duties to each other and as compensation for the value that all Americans create. So in the plan, we have a UBI of $1,300 a month for adults, $433 a month for children, paid with Treasury dollar bills, which is legal tender issued by the U.S. Treasury. So today I wanted to talk a little bit about the economics of universal basic income. We have a fair-sized, UBI movement. And I think that, it's very important to ask the question of, of macroeconomics around UBI. So, what would be the effects of instituting a universal basic income? What could economic analysis tell us of what would happen? Would it increase prosperity and eliminate poverty? Would UBI result in inflation is a very common question. So I'll talk about a little bit, first of all, sort of the standard economic theory that is widely used today, is used by the Federal Reserve, and most people learned about it in high school economics and are explicitly or implicitly familiar with this. So in a very small nutshell, the basic Keynesian theory is sort of a Goldilocks theory of economic stimulus. So if you put in too much economic stimulus and the economy gets too hot, then you get inflation. If you don't put in enough economic stimulus and the economy gets too cold, then you have an economic downturn. And the idea is to put in just the right amount of stimulus, not too much and not too little, so that you avoid both inflation and unemployment. And those are sort of in the mandate of the Federal Reserve. Some questions here about this theory. So, you could ask the question, how do you determine how much stimulus is too much? How do you determine what's the right amount? And other questions such as, can you have both problems at the same time? Can you have problems of economic weakness or economic downturns at the same time that you have inflation? And if you did, why would that occur? What would be the reason that would occur? And if you have both problems, what do you do? So, for example, in the 1970s, famously, we had sort of stagflation, which is stagnation and inflation, both problems at the same time. And I think it's important to try to figure out why that occurs. So if we go back to the first question about how much stimulus is too much, the basic theory of inflation is that that inflation occurs when demand overwhelms productive capacity. That's the basic theory. So the idea is, if you imagine the economy as sort of an enormous factory, then it will have a certain amount of productive capacity. The economy will be able to produce, say a million widgets per year. That is the maximum output of the factory. And so if you put in too much stimulus and you get too much demand, and consumers are trying to buy more widgets than the factory can actually produce, then what will happen is that you'll get inflation because the factory can't produce more output. Instead, what happens is that excess demand just causes the prices to increase. and that's inflation. So then we should ask, how do you measure capacity, and how do you measure capacity utilization? So I think this is a very central question to how this all works. And yet, in the standard sort of economic materials, there's very little talk about capacity and how to measure it. But if you dig around on the FRED website, that's the St. Louis FRED economic data, we actually do have a measure of capacity utilization. And it's done by economists who go around to as many businesses as possible. And they ask the question, what is the maximum that this business could produce? How many widgets per month could they produce? And so if they can produce, say, 1,000 widgets a month, then they ask the question, well, how much is the business actually producing? And usually the business might be producing 700 widgets per month, even though their maximum output is 1,000. And the reason that they only produce 700 is, generally speaking, that that's how many widgets they can sell. So if they can't sell it, they won't produce it. So if you look at capacity utilization as measured by the St. Louis Federal Reserve, it is currently at 78%. So this is capacity utilization from 1967 to 2022. Okay, so I would argue that this is a good indicator for how well utilized the entire economy is in general. And I would point out an interesting trend, which is if you look at this period from 1967 to 2022, it's quite evident that there is a long-term downtrend here. You can see recessions, which are in gray. So recently we had the pandemic. We had a recession in 2008, 2009. This is the recession associated with the tech bubble crashing, around 2000. So you can see recessions, they have a sort of a short-term downturn, and then you have a recovery. But in addition to these recessions, again, if you look at a larger time scale, you actually see the entire chart trending, very clearly downwards and to the right, from 1970 to the present time. Here, I would like to introduce capital consumption theory, which I would like to propose as the theory behind UBI. And I want to provide a little bit of sort of prerequisite familiarity here. So, one of the things that you'll need to understand this, but at a very basic level, is the idea of feedback loops. And feedback loops come from control theory in engineering. So the basic idea is you have some action which results in some result, but that result also feeds back and eventually causes either more action or less action. So to make this a little bit more concrete, an example of a negative feedback loop, which most people are familiar with, is your thermostat. So if you have if you are, heating your home, and the heater has a thermostat on it. So say you turn the thermostat to, 75 degrees. And what happens is that, because it's winter, and the house is quite cold, when you first turn it on, the house may be lower than 70 degrees. And so the thermostat will tell the heating element to turn on. The heating element then heats up the room, and as the room temperature rises, the thermostat also has a thermometer which measures the temperature. And what happens is that that's the comparator here. So your heating element heats up the room, and then eventually, when it gets above 75 degrees, and because this is a negative feedback loop, what happens is that when the temperature rises too high, the thermostat will tell the heating element to turn off again. So the heating element turns off, and then the room starts to cool back down again. And then so the room cools down, and then when the thermometer reads that the room is too cold again, then it turns the heating element on again. So this is a negative feedback loop, which causes sort of a stable level. So when the temperature is too low, the heating element turns on, heats it up. When the temperature is too high, then the heating element turns off, and the room cools down. So that's a negative feedback loop. You have a different type of feedback loop also, which is called a positive feedback loop. And that occurs when the feedback causes an action which will sort of push in the same direction. So for a concrete example, like a fire would be an example of a positive feedback loop. So if you had a bonfire, a large stack of wood and flammable materials, and you start a small fire, then the small fire, in one corner of your heap is going to create a lot of heat. And what that heat does is it will cause the neighboring materials to also catch on fire. So that causes even more heat, and it catches more stuff on fire. And so you have sort of a growth a mechanism. The fire builds and spreads. Another example of a positive feedback loop would be going viral. So if you have a tweet and people share it, and then other people see it, and then they share it also. And so the more people see your tweet, the more people share your tweet, which causes more people to see the tweet. And so that goes viral, which we're all familiar with. Another example is wealth accumulation. So when people have some capital to invest, and then they make some money, and that means that the next year they have even more capital to invest. So the next year they will make even more money. And that's a positive spiral, positive feedback loop, which results in, when people are wealthy, they tend to, the more money they have, the more money they make. So that's a positive feedback loop. And we will be talking about the wage spending feedback loop, which is, what I call the consumer worker, which is basically consumers who are mostly also workers or depend on workers for income. They receive their wages, they spend that into the economy, and then when businesses receive those revenues and they need to deliver products, then they hire more people, and so you end up with more wages. Spending results in wages, wages results in spending. So I want to point out here that positive feedback loops can operate in two modes. One is growth and one is stagnation. So the examples that we talked about were all the growth mode. But if you think about it, these can also operate in the stagnation mode, which is a downwards, not enough, or a downwards tendency of these variables. Then you can have stagnation rather than growth. So how that works, if you have a fire and then you're dumping lots of water on it and then it's cooling down, and eventually parts of it are no longer on fire, so there's less heat being generated, which causes other parts to also die down more easily. And so if you put enough water on the fire, then the fire goes out and will no longer be on fire. With going viral, if you've had a tweet that does not get retweeted and does not get liked, then you'll notice that it gets very little action. And since no one is seeing it, then no one is liking and retweeting. And since no one sees it as a result of that, then you have just a sort of a flat stagnation. If it goes viral, but if it doesn't, it also doesn't. Wealth accumulation, for people who are not wealthy, who don't have a lot of capital, I would say most people in the US are sort of in a stagnation mode here, where they are maybe struggling to bring in enough money to spend. they have very little savings, and because they have very little savings, they can't invest, and their income sort of stagnates, and they never get into a big wealth accumulation mode. And of course, the most important here, this is what the relevant part that we really want to talk about is wage spending. So how does that relate to the economy? Here's the capital consumption model of the economy. The economy is a partially automated factory. It has a lot of capital and a lot of productive capital, which helps our labor be more productive. So a lot of automation, basically a lot of capital, which creates a lot of tools, which create a lot of productivity out of labor. But it still needs labor to some degree. And the positive feedback loop that we were just talking about occurs here. We have the consumer worker on the left, and the consumer worker provides labor into the economy. He or she, they get out labor income from the economy, and then they turn around and spend their money to receive the economic output of the economy. So the more the consumer worker spends, the more economic activity you have, and the more labor is required, and so the more labor income goes out to the consumer worker. And I would argue that from the 1970s to the present era, what you have, if you remember that two slides back, we were looking at from 1970 to 2020, we have this steady downwards movement of capacity utilization. Utilization is getting lower and lower for the last 40 years, 50 years, 40 years. So the factory is less and less well utilized. And why does that happen? I would propose that occurs because you have this positive feedback loop, which is in a stagnation mode. And so, basic wages have been flat for the last 40 or 50 years. And what happens if labor income is sort of stagnant is that will mean that consumer spending will also be relatively stagnant relative to how much the economy can produce. So the consumer worker is not able to purchase the full production of the economy. And the more they are not able to purchase the full production of the economy, the more that also drags, again, on labor demand and labor income. And so that is a sort of a vicious cycle of stagnation, which has caused from 1980 to the present, has caused the utilization of this economy, this partially automated factory, to go ever downwards from 1980 to the present. That's what you see here. You see that. Okay. So where does UBI come in? UBI is something that if we put enough UBI income into the hands of the consumer worker, such as the $1,300 a month and $433 a month for children, that the Blueprint for a Better America proposes, the direct effect of this would be that consumers have more money to spend. That would cause utilization in the economy to go up. So we would actually be producing more of the widgets that we're capable of producing, rather than having that capacity go unused. At the same time, that would also increase the demand for labor. And when you increase the demand for labor, the result of that is that wages tend to go up. So labor income would tend to go up, and wages would tend to go up. So again, a very common question about UBI is, well, would this cause inflation? And so, the thing to realize here is that inflation comes in two types. So again, if we go back to this capacity utilization chart, we had inflation in the 1970s, and we are starting to get inflation right now. And the standard economic theory, the Goldilocks theory, is that when you have too much stimulus and it overwhelms the productive capacity, then that gives you inflation. But the standard theory doesn't really fit here because, again, if you look at capacity utilization in the present era, it is actually very low. The long-term trend is really is actually sort of near century lows. It's actually close to where it was, relatively close to where it was around the time of the Great Depression. So if your capacity, if you're not at the limits of your capacity, then you have to ask, why are you getting inflation? And so, capital consumption theory says that in addition to high utilization, type 1 inflation, which is the type that most people understand and talk about, you also have type 2 low utilization inflation. Low utilization inflation occurs when we have this effect where this consumer worker is stagnating, utilization is going down. And one of the effects of this is that, so there are a couple of different effects. So one of the most important effects of this is that the elasticity of demand becomes more inelastic. So what does that mean? That means that if you think about sort of all Americans as a pool of consumers, and when businesses are selling to this pool of consumers, they have a choice about how much they will price their products at. They have a choice about whether or not they will raise prices. So if you imagine that there's a lot of income inequality in this pool. Some people, maybe the top 20% are doing quite well, but the bottom 80% are pretty much struggling. And that trend is actually getting worse because income inequality has been getting worse for the last 40 years. When businesses are deciding whether to raise the prices or not, they may find, as they have recently, that when they raise the prices, when the small pool of consumers at the top who were able to afford the products, they are also able to afford a price raise. So if you raise the price 10% on them, they'll still be able to afford the product. And maybe the bottom 50% is not able to afford the product anyways. And so when you raise the price on them, they were never buying it even at the original price. And so what happens is that businesses find that when they raise the prices, the quantity that they sell does not go down very much. So maybe they raise the price 10%, but the quantity they sell only goes down 1%. And they find that is actually very profitable. And so that happens under conditions of high inequality, which happens under conditions of low utilization in the economy. So in the current era, UBI would actually act to stop type 2 inflation. So if you look at, in Alaska, they have this very famous sort of UBI-like resource dividend every year. And every year when the checks come out, all the businesses have an enormous sale. Now, you might think that because, people have lots of money, that businesses would raise prices, but it's actually the opposite. What happens is that when you put out money into the hands of all people and everybody in the state of Alaska is a potential consumer, what happens is that businesses will actually lower the prices so they can capture as much of that share of consumer spending as they can, because everybody has money in their hands suddenly. Whereas, if only the top 20% had money in their hands, then they would find that they can't, the bottom 80% won't be able to buy the stuff anyways, so they might as well raise prices on the top 20%. So UBI in this era would actually work to stop the type 2 inflation that we're experiencing. So Brian,
questions about capacity utilization.
Yeah.
Like, how does that change over time, right? Because we're producing very different things. How does the measurement change over time? Because we're producing different things. And I guess I'm thinking of things like computers and stuff that we weren't really recording back in the 1970s.
Yeah.
And yeah, could you speak to that?
Yeah, so I mean, the mix of products are going to change over time, and there's new products being invented all the time. So, also didn't have iPhones in the 1970s. And then some products are also going out of fashion. So, when the automobile came out, then the horse and buggy, went away. Know that we have iPhones and microcomputers. They used to have mini computers and mainframe computers, sort of room-sized things. There's always things being added to the economy and things being taken out in terms of what products there are. So the capacity utilization measure does not it does not, that's sort of external to the measure. So it does not does not attempt to capture that. But it is, the capacity utilization is a broad-based measure. So it attempts to be broad-based. So it attempts to look at, we're not going to just look at one industry, like just the steel industry, or whatever. We're going to look at steel, oil, lumber, automobiles, household appliances, clothing, basically anything at all that they can easily measure the output capacity of in the economy. They're going to put all of that in. So it's a broad-based measure. It doesn't attempt to look at what's going in and coming out of the economy. And I would think that at a first level approximation, it's perhaps not terribly important, at least individual products sort of coming into existence in the economy or going out of existence. Like individually, certainly they would not, that would not necessarily change the broad capacity utilization.
And it only looks at manufacturing, right? So if you manufacture frozen pizzas and
Yeah,
you're only working at 50% of capacity
yeah,
versus Pizza Hut making fresh pizzas at 90% capacity, they're super busy.
yeah,
That wouldn't get captured, Pizza Hut.
yeah, yeah.
Okay.
Honestly, Pizza Hut, the specific example, I'd have to dig further. I can't, I don't.
I mean, I guess so. I guess where I'm going is more like services.
Yeah.
And so utilization
Services
of
are probably,
services.
yeah. Certain businesses in the economy are certainly not represented in this measure, because some of them may have, sort of very hard to capture levels of capacity. So if you thought about like Netflix.
Oh yeah, no. So
Yeah.
as America has sort of more shifted from being less manufacturing to more of a service oriented society, is that part of what's reflected in this chart?
So does the shift to services cause capacity utilization to go down? So that could perhaps be a hypothesis. I would guess that it does not affect capacity utilization, because utilization is going to be a little bit, it's going to sort of equilibrate a little bit in the economy. So for example, if people are working at the steel factory, but suddenly there's not that much demand for steel in the domestic economy, and so they have trouble finding work, then they will somewhat sort of migrate into other industries. So perhaps they migrate more into some type of a service industry. That mechanism where the factors, the inputs, the economic inputs, they'll tend to equilibrate across the entire economy, where if something is being used very little, not very well used, then it will become cheaper, and then other sectors of the economy may sort of start using that input. If it's being used too much, other sectors will tend to maybe decrease their usage because the price is suddenly very high. But the idea is that we're trying to capture the broad-based state of the entire economy. So this is not a complete measure of the entire economy, but I would argue that it is a very good it is a very good indicator. It is a sufficient portion of the economy that it does capture utilization. And there are other, but there's numerous other data which tells me that utilization is really, low utilization is really what's going on. So another aspect of it, in a nutshell, is that capital is sort of a very broad-based concept. So investors could invest in a shoe factory, or they could invest in a hat factory. So depending on what's selling well, they'll sort of shift their capital around. And what you have from the 1970s to 2020, during this same period, you actually have the same long-term trend with interest rates. That interest rates are highest around the 1970s, and they're in a long-term trend downwards from 1970 until the present. And that interest rate is basically the price of capital. What it tells you is that, if capital sort of factories are very much in demand, they're well utilized, the consumer is demanding lots of production, then you will end up with getting sort of a high return on that capital. And what we have instead is that from the 1970 to 2000, that return is going down, lower and lower and lower. That's reflected in the interest rate. And in standard economics, as far as I can tell, there's no good explanation for that. The closest thing is the idea of a savings glut, the idea that interest rates are low because of a savings glut. But if you think about what a savings glut is, the savings of the economy are supposed to be, sort of invested back into the economy, used to build factories and whatnot. So what does it mean if you have too much savings? Well, if you had lots of savings, then why wouldn't you build lots more factories and make the economy much more prosperous? You could always build more factories if the demand was there for the consumer worker. So what's really happening is that because the consumer worker is not able to generate the demand because their income is not high enough, then your savings glut means that income and financial capital, money, is pulling over here in the hands of the capitalist. And when they go and say, maybe I'll build a shoe factory, maybe I'll build a hat factory, but they find, they do some market research and they find, well, the shoe factories that are open right now, they can't even stay busy. So if we build a new one, it's probably going to be, pretty empty also, and it's not going to be very profitable. And so that capital actually loses productive outlets. So you see interest rates going down. You see wages stagnating from 1980 to the present. That is actually there in the data. So you have numerous different data that all tell the same story, which is the story that you have an economy that is more and more underutilized, and resulting in stagnant wages, low interest rates, things like this.
But so for other service industries, technology, like Netflix, right? Netflix's capacity utilization is irrelevant for the point of this chart. Google, Facebook.
So for the purpose of this chart, I would be fairly certain that Netflix is not included in this chart. So they're not measured. Their capacity is not measured. Their utilization is not measured. Only the businesses that have a clear capacity, then the economists, they say how much is the capacity and how much of the capacity is actually being used. And so what they find is that very broadly across the entire economy, for everything that you can measure this for, factories are going more and more, and businesses of all types, are being less and less used. And I mean, if you want to, I would suspect that, say, like shopping malls or restaurants or things like this I would suspect that they're not covered in this measure. But you can actually go out for yourself and go to the stores in your area, and you can imagine what would be the busiest that this restaurant could be, and what is it actually? And I think that, from your own observations in the economy around you, you'll find that utilization is actually quite low. You could be producing, if you have ice cream shops, you could be, producing much more ice cream for people and making them much more happier. But you don't. Most businesses are sort of operate well below capacity. There will be some like sort of superstars, so like Starbucks, in some locations manages to stay very, very busy. But I think, overall, the picture is low utilization, and the wage data and the interest data and the valuations in the financial industry, all point to in the same direction here.
And so UBI would have a tendency to drive up or to bring up interest rates, which
Yeah.
would then also encourage the greater development of industrial capacity.
It would reflect the greater development. So UBI would increase demand. Increased demand would encourage more investment, and increased investment demand would cause interest rates to go up. So if the economy is demanding more capital investment, then that would cause the price of capital to go up.
Wouldn't it cause interest rates to go up because the Federal Reserve or the central bank or whatever would want to raise interest rates to reduce the amount of new money, since UBI would be fulfilling a lot of that function?
Yeah, so the Federal Reserve is a separate mechanism. And so it's interesting here because so you have one measure, interest rates. You can see what that is. And then you have basically two different causal mechanisms. So one causal mechanism is an increase or decrease in investment demand will influence interest rates. More demand means higher interest rates, less demand means lower interest rates. On the other hand, you also have, feeding into the model, the Federal Reserve. And what they're doing is that they are, if there are sometimes, they're lowering interest rate, they're putting money into the system to lower interest rates when they're afraid of a recession, and they're trying to take it back out when they're afraid of inflation. And most people make the mistake of assuming that the Federal Reserve is the reason for interest rates coming down, that they set the interest rates and interest rates are low because the Federal Reserve set them low. But I would argue that is actually not correct. So if you think about, if you look back at the Federal Reserve and what they were saying in around 2000, if the Federal Reserve said, we have this plan, or even in 1985, or 1990, if the Federal Reserve said, we have a plan to drop interest rates all the way down to the zero and, do an experiment on whether interest rates can become negative in 1985, and then they did it, then I would say like that model of reality, that hypothesis would be well supported. But if you look at what they're doing, what they're saying throughout this entire period, they don't say that at all. And around 2000, even 20 years ago, they were, starting to say, interest rates are a little bit low. Maybe we should raise them, but we don't see inflation, and we're still a little bit worried about the economies. So, they sort of did their best. But they're definitely not in the driver's seat. And I would argue that people, because they know about the Fed, they assume it's the Fed. And I would argue that people are not aware of this other causal mechanism, which is actually the larger causal mechanism, which is the question is, how much investment demand does the economy produce? And so if the economy is very well utilized, it will produce a lot of investment demand that will create a lot of demand for capital, and that will cause interest rates to go down. And if the economy is not very well utilized, that will cause less investment demand, less demand for more factories, more businesses, whatever. And that will cause interest rates to go down because there's not as much demand for that financial capital. So I compare the Fed. There's a scene in The Simpsons, the opening, scene in The Simpsons, where like Margie is driving the car, Marge is driving the car, and Margie, the baby, is sitting next to her, and she has like a toy steering wheel, and she's, there, she's doing the same thing. So it looks like Maggie's her name. Maggie is driving the car, but that's not actually the case. I would compare it. It's sort of a little bit like that. And the thing is that the Federal Reserve is reacting to something. And what they are reacting to is they are taking economic measurements of the economy, and they're looking at how the economy is doing. Is it growing very fast, or does it look like it's beginning to stop growing? And so what they're really doing is they are actually reacting to low demand also. And so they're also working in the same direction and saying, when demand is low, then we're going to put more money into the economy, but they put it in on the right side here with the capitalists through the debt markets. And so they're putting it in the wrong side. So you have low demand, and you have capital pooling anyways, but the Federal Reserve, has this idea that we'll boost the economy by putting money in, but they put it in at the wrong side. They put it on the right side, or you could say the top.
I like to say they put it in at the top of the economic ladder instead of at the bottom.
They put it in at the top instead of the bottom, and the top already has too much capital pooling, and so that's how you get these enormous asset bubbles, and all the crazy things that are happening in markets right now. And what they really should be doing is putting it in at the bottom, and they could probably actually afford to take a little bit out at the top at the same time that they're putting more into the bottom. And that's what
That's the value added tax.
That's the value added tax would be good as a method for taxing businesses, because businesses don't pay very much income tax because they run very close to zero profit margin. So they're able to avoid income taxes in that way. And a value added tax would be good for taxing businesses. I guess I'll call the presentation and American Union economics officially closed now. So